Ok rồi, chào mọi người. Welcome to the 11th class. Ok. Buổi này là buổi học thứ 11. Okay. Thì mình cũng đã biết được nhiều vấn đề, nhiều chi tiết của cái ngành nghề này. Ok. So yeah, thank you for come to the class on a Friday night. I will try to stick to 1 hour. Maybe a little bit fast, today too. I mean, like I'm gonna talk fast because I have extra slides. So bear with me. Like I said, if any of the material that that you don't get it, just go back and take a look at the video. Okay, and that's gonna help you prepare for your examination. Okay. Okay. 11th class. Okay. So similarly, right, all these add. Okay, so today we're gonna talk about the non-traditional, right? We're talking about traditional, conforming, non-conforming, okay, super jumbo, Fannie Mae and Freddie Mac guidelines standard. So any of those are matching with the guideline will be conforming, or traditional loan programs. Anything out of that, including adjustable rate, ARM, or government loans. Okay, so those are the loans that we call non-traditional, and today we'll cover the three most popular. Actually, I should say that the 2 out of the 3 are the populars. Okay, FHA and VA are the most popular. USDA, we rarely hear about it, but there are people that are using USDA as well. Okay. So what is FHA? Okay, FHA is a Federal Housing Administration, and Federal Housing Administration has its own loan program, which is what we call FHA loan, okay, or FHA mortgage. Okay, FHA loan is a home mortgage that is insured by the government. Congratulations, right? So we have the government, back our loan. So any other loan that we have out there, like conventional loan that we discussed in the last class, are provided by the private investors, banks, credit union, right, and financial institutions, right, including insurance companies too. Okay, but those are not backed by the government. Only FHA, VA, and USDA are the one that backed by the government. Okay. However, the two entities that are sponsor, okay, not backed, it's sponsored by the government, or Fannie Mae and Freddie Mac, will buy back the loan programs that those bank, investor, credit union, lending out to the consumers. So when they sell that sell that to Fannie Mae and Freddie Mac, we call it selling to the secondary market. Okay, secondary market is a market that will buy the loans, keep the loans, servicing the loan, and then give the money back to the lenders, to the bank, so that they have more money to lend. That's what we call secondary market. Okay, the forefront are the banks, right, taking into loans, the primary market, and then we sell that back to the government sponsor companies, private companies, so that now they can share some money, some funding back to the bank so that they can lend again. So now we're talking about FHA, right? FHA are insured by the government, and FHA, which is a part of HUD. What is HUD? Housing Urban Development. Okay, which is sponsored by by the HUD or part of the HUD. Insure the loan, so some of your lender can offer a better deal. Okay, FHA, some facts about FHA loan. First and foremost, that you can down as low as 3.5%. So when you down at as low as 3.5%, meaning that you're a graduate, you're a student, you're low income. I shouldn't say low income, but you don't have enough down payment, right? You haven't saved enough, and you have the need, but you can qualify for a loan, right? You can have a good job, stable job, right? But you just don't have enough down payment. So the FHA is, is a mortgage loan program that can help, those kind of borrowers, right? With as low as 3.5%, and also some low closing costs. Easy credit qualifying, intended for certain borrowers. Like I say, people with bad credit, people with low income, low saving, and all that. The federal government insure FHA loans, and also FHA borrowers tend to be riskier because like they don't have, they don't have good credit score, they don't have good saving, right? So they are we call them risky, borrower. And because they are risky borrower, they must pay higher interest rate and also have to pay PMI. Okay. I assume that you guys do see my slide, right? Not only the first page, right? Okay. So banks are more willing to loan money to home buyers with relatively low credit scores and little cash to put down on the purchase, as long as it's sponsored by the government, as long as they get able to get an FHA. So meaning, for example, Bank of America, Chase, Wells Fargo, right? They do have FHA program too, right? To help these borrowers. So FHA loan, good for the first-time home buyers, like I mentioned earlier. FHA has financing for mobile home as well, and some factory-built housing. What are the mobile homes? Mobile homes are, the home that could be a manufacturer home and put on, like a movable trailer, as well as on like a permanent, foundation slab, right? Concrete slab. But, they are manufacture a home, or sometimes they can just a mobile home that put on an empty land. So that, those are the mobile home. Factory built housing. Factory built housing is that they assemble it in a factory, right? In a big, factory building. And then they haul it, they put on a tractor and they haul it to a site. Either put on like, like a crawling space foundation, or they can put on a slab. Okay, so FHA financing those, right? Not only single dwelling unit, 1 to 4 and all that, but they also financing for mobile homes and factory built housing as well. All borrowers are required to pay the closing costs, including lender fees, third party fees, and prepay items like interest and property tax. Okay, borrowers are also in the hook for the annual mortgage insurance premium, so they have to pay the PMI. The big thing about this is about the PMI. And guess what? When you're down like 3.5%, you're gonna have to pay a long time, right? Until you reach it up to like 20%, 22%. Okay, some advantages and disadvantages of FHA loan. The pros are available to borrowers with lower credit score, lower down payments, and federal-backed mortgage. The cons are requires purchase of PMI and its ongoing premiums, cannot be used for second homes or investment property, meaning that you cannot buy or you cannot use the FHA for the second home or a rental property. You can only using FHA for your primary home, the home that you live in. Okay, but people sometimes they live in for a couple months, let's say 6 months, and they move out, and that loan still stick with the property. Okay, and also they have a higher interest rate. Not all properties are qualified. Okay, because there's some some interesting fact about this is that let's say nowadays that we do see people that buy a home, what they call is flippers, right? Flippers are they buy the really bad condition home, and then they renovate it and then they resell it back to the market, right? Whoever want to buy it at a higher price. Sometimes they put like 50,000, 75,000, 100,000 to renovate, and then they jack up the price at least 100K, 200K, and then sell it back to new home buyers, right? But there's a guideline that for those flippers, they cannot sell the home until, I believe it's 60 days after after the first purchase. So FHA, borrowers cannot buy those homes, right? The home that sold by the flippers. Okay, so they have to wait for a period of time. But usually flippers, they want to flip it. They want to get their money back so that they be invested into a new flipping home, right? So meaning that sometimes on the MLS, the multiple listing services, they did say FHA is not qualified for this because they want to close fast. They don't want to wait for 60, 90 days. Okay, so keep that in mind. There's a good neighbor next door program. Okay, this program or mortgage program eligible to the public service employees can purchase a home at 50% off. Yes, you heard it right. 50% off the purchase price. Okay, through the Good Neighbor Next Door program, which is also provided by HUD. What it means is that there are certain homes. Hopefully that's a new home. Okay, the new home they build. These buyers using the Good Neighbor Next Door program, they go out, right? They pay for let's say that home is like 500,000. Let's bring it up higher, 800,000. Okay, and then these buyers gonna buy that home at 400,000. The government gonna subsidize that, depending if the builders build those homes, and sell as a 50% off, or and the government gonna pay them the difference, right? Or they sell at 800, and these people using the Good Neighbor Next Door program coming in, that they pay by 50, and then government pay the other 50. And guess what? Once they buy that property, and then at the time that that they want to move, they want to resell it, they can only resell at 50%. They cannot resell at the market. They can be resell at the market price, but 50% less. Okay. So that's something really interesting about the Good Neighbor Next Door program. So what are required for the FHA, right? All that's required is that you are currently, for the Good Neighbor Next Door program requirements, right? You're working as a full-time pre-K, preschool, kindergarten through all the way 12th grade teacher, right? You also may be an emergency medical technician, a firefighter, a law enforcement. Okay, so those people are qualified to use the Good Neighbor Next Door program. But like I say, you buy it at 50, you sell at 50. Okay, some prohibition on the FHA mortgage insurance. Okay, we talk about this, right? On some of the previous loan, but now we talk about FHA, right? During the mortgage lending, you may hear a lot about MIP, which is a mortgage insurance premium. You may hear the term about LTV, loan to value, right? So how long will you pay the annual mortgage insurance premium? Okay, if you have the term that less than 15 years, then your loan to value is like less. And if your loan to value is less than 78%, and you're gonna pay about 11 years total. Okay, if your term is like 15 years or less, then if your loan to value is between 78% to 90%, then you're gonna have the same period for paying the MIP, the mortgage insurance premium. Okay, if your term is less than 15 years, when I say less than 15 years, it's either less than or equal, I should say, which is 15, 10, right? Then those are the terms. Okay, for this scenario here, like if it's less than or equal to 15 years, and your loan to value is greater than 90%. Greater than 90%. Let's say you down 3.5%, then now your loan to value is 96.5, right? So it's greater than 90%, and now you're gonna pay for the whole loan term, right? If it's 15 years, you pay 15 years. If 10 years, you pay 10 years. Okay. And if the loan term is greater than 15 years and your loan to value is 90% or less, then you pay 11 years. However, if your loan to value is greater than 90%, meaning you down less, right? You down like 10% or less, then you have to pay the MIP for the whole loan term. Okay. Okay. So here's something different. Okay. You know that conventional loan, right? We heard about the PMI. It's called Premium Mortgage Insurance. But for the FHA, it doesn't call PMI. It's called MIP, which is Mortgage Insurance Premium. So make sure that you kind of aware of the difference, right? It's the same thing. Okay, the term and the way that how they calculate may be different, but it serves the same purpose. Okay, it serves the same purpose. But for the conventional loan, when we're talking about we're talking about the private mortgage insurance, it's PMI. But for the FHA, it's called MIP. Okay, VA may be different too. Okay, FHA interest rate calculation scenario. Okay, here's an example. The principal amount of the loan time interest rate equal total annual interest rate. Total annual interest. Okay, total annual interest you divide by 360. That's equal to the per diem interest. Okay, total number of days for which the per diem interest is payable. Per diem interest times the total number of days for which per diem interest is payable equal to the total amount of interest payable at closing. So what does that mean here, right? This whole scenario here is not talking about calculating the monthly mortgage, okay? This whole scenario, this whole example here is show you how to calculate the per diem, okay? The per rate, the remaining of days for that particular month when you're buying a home and about to close. Quick and easy, answer, explanation to this is that if you're buying a home at the day 15 of the month, then they're gonna per diem for the remaining 15 days. Okay, and they're using that by first calculating, the loan amount multiplied by the interest rate to get the total annual interest in dollar amount, and to get that they divide by 360 per diem equal to per diem interest, right? For per day. Okay, and then they take the number of days, like 15 days remaining. Then they take the 15 days, they time the per diem interest. Okay, and that is how much they're gonna pay at closing. Okay, so you pay 15 days of per diem interest, or if you close on the 20th, then you pay 10 days of per diem interest, or if you close on the 5th of the month, then you pay 25 days. Okay, or depending if the month is like 28 days or the month is 30 days or 31 days. Okay, that's also make it different too. Okay, so like I said, this is a per diem interest calculation. Okay, FHA loan. There are 5 types of FHA loan. Traditional mortgage, a mortgage that finances as a primary residence. Okay, home equity conversion mortgage. So what we're talking so far, right, are FHA that that lend to the borrower who purchased the home as a primary home. Okay, so that is the first type of loan, FHA loan. Okay, home equity conversion mortgage. It's a reverse mortgage that allows homeowner ages 62 plus to exchange home equity for cash. Let's say there's a baby boomer, right? That person now is 70 years old. Okay, and now instead of keep paying, the mortgage, let's say $1,000 a month, right? And instead of paying for that, this home, that person probably bought it like 30, 40 years ago. So there's some equity in it, right? But they still owe like $1,000 a month. Okay. So now they can take what is called a reverse mortgage or home equity conversion mortgage. Reverse mortgage equal to home equity conversion mortgage. So keep that in mind. Okay, so don't forget that, right? So the reverse mortgage that they do is that in order for that person to be able to qualify for the reverse mortgage, remember this will be on the test. They need to be a minimum of 62 years of age or older. 62 years of age or older, right? And meaning that instead of keep paying to the bank for that 1,000, now they take out the money, right, from the equity. And then let's say if they're able to take out $3,000 a month, right, but they owe the bank another 1,000, so they get that 1,000, they paid it to the bank, and they keep 2,000 for spending, and they can do that for as long as it's drained out of the equity that they have. Okay, and when that equity, the equity is drained out completely, they're not going to get any more money, right? But they can stay in that property as long as they still live. So meaning that if they don't die, they're going to live there forever. If they die at 80 years of age, 90 years of age, the bank going to take property, right? Let's say if that property by the time that this person died, still have some equity, the bank going to short sell it, right? Sell it, get the remaining, paid back to the inheritance, a wife, a husband, or whoever lived behind. But here's a catch, right? If that person has a wife or husband, then the wife or husband going to live in that house until she or he died too. Okay, or she or he moves somewhere else. Okay, so the reverse mortgage are helping the senior, right, to stay in the home until they die, or until they take out all the equity and still live there until they die. Okay, so take a note of that. The third kind of FHA loan is the 203K mortgage program, which is a rehab. Okay, it's 203K. When you hear about 203K, it's a rehab loan provided by FHA. What is a rehab loan? A rehab loan is similar to the flipper way of doing things, right? They buy a bad home, then they renovate it and they resell it. So now FHA say, hey, you borrower, right? You can go out and buy a home that probably needs some work, some renovation before you can live in it, or before you live in a satisfied condition of the property. So we have a mortgage for you, right? You can borrow the money, renovate the home, and that besides the money for you to purchase the house, right, this additional loan that you take out will going to be combined and added up. Okay, so the 203K is a mortgage that includes extra funds to cover the cost of repairs, renovation, and home improvements. Okay, that's how I explain it. The fourth one of FHA loan is energy efficient mortgage program, a mortgage that includes extra fund to pay for energy efficient home improvement. Similarly to the 203K, the energy efficient mortgage program can lend the borrower who qualified for the FHA 10 grand to upgrade the AC unit, right? Or another 20 grand for the solar system. And all that is adding up into the loan. Okay? Now, the last FHA loan type is Section 245A loan, which is a graduated payment mortgage. Has a low initial monthly payment that increases over time. A growing equity mortgage, which is stand for GEM, has scheduled increase in monthly principal payment for shorten the loan term. Okay, so if you're aware as a conventional loan, right, you go for 30 years, a term of 30 years, you pay $3,500 a month, you're gonna pay the same thing, $3,500 forever, for 30 years, for 360 months. Okay, however, within a conventional loan, if you pay additional $500, or 1,000 a month, guess what? You're gonna pay still 3,500, but not for 360 months. You probably gonna only pay 340 months, meaning that any additional principal that you pay upfront gonna shorten the amount of time from the end. So this program here from FHA is doing the same thing, right? A new student just graduate, able to borrow an FHA loan, right? But they say, this person is 22, 23 years of age, still young, right? He or she may eventually, going to have higher income. Right now, he or she may get $35,000 pay, but next year he may get $85,000 pay, or even higher, for the subsequent years, right? So meaning the program have this program lay it out, section 245A loan lay it out, say every year you're going to pay more, okay? And you pay more, meaning what? You're going to shorten your time down, okay? Unless you refinance, right? And then your loan going to be different, no longer the FHA loan, okay? So that's how the GEM works. Okay, we just done the FHA. Now let's talk about VA. Okay, VA mortgage loan or mortgage programs. A VA loan is a type of mortgage loan designed specifically for eligible veterans, active duty service members, certain members of National Guard and reserves, and qualifying spouses of veteran or service members. So like I said, the VA is mainly for military and service members alone, right? Whoever have the VA status, he or she or his or her spouses are able to borrow the the money from the VA loan program. Okay, keep that in mind. These loans guaranteed by the U.S. Department of Veteran Affairs, which is VA, Veteran Affairs, VA, and VA has VA loan, so we call VA loan. Okay, are intended to help military personnel, veterans become homeowner by offering favorable terms and reduced or no down payment requirements. So when you think about it, right, people joining military, right, they go and they serve, they go overseas, they serve, right, and when they come back or when they get out from military, they may struggle, right? Most of people are struggle, and they probably not gonna have enough money to buy a home. They may not have enough credit and all that. So VA stepping in and they say, okay, for those people who are responsible, who are able to save some money, who are able to get a job, either from military, contractor, or anywhere, right? And they are responsible. So we have a loan program for you to purchase a property. Okay. So this is why this program is really helpful for military personnel. The big thing about VA is that you don't have to have a no down payment. You don't have to have a down payment if you don't want to. Meaning that you can go out and then you can buy a home with no down payment. How cool is that? It may sound cool, but guess what? Your payment is high too, right? Because you don't have any down payment. You don't have any equity in it. But at least it's helped you to qualify to pay for a home. Probably you're not going to be able to buy a $600,000, $700,000 home, but you can buy a condo. You can buy an apartment, okay, a townhouse, right? But if you're able to qualify, you get a good job, and you VA status, you can also buy a big home too. And remember how I discussed about the limit of the VA of $1.5 million, right? You can use that amount up to that, that range. Okay, so no down payment. One of the most significant advantages of VA loans is that they typically require no down payment. Borrowers can finance up to 100% of the purchase price of a home without the need for a down payment, making home ownership more accessible. This may not, if you actually in the real estate industry, people may not talk about it, but having a VA loan also gives some disadvantages when you go out and you offering and buying a home, because like seller, they're gonna sell to cash offer first. Seller, they're gonna sell to people that now 20% first, right? And a seller gonna sell to people that actually have some down payment, right? Some good credit score and things like that. So sorry to say, but I think life is not that fair. But guess what? There are homes that's sitting on the market for so long and nobody buying it, and then VA coming in, right? But like I said, there are also some cases that VA loan is sometimes able to compete too. Guess what? Because they don't have to down that much, they can raise the price, right? As long as they qualify to to pay for the mortgage, they just raise the price, right? The conventional folks coming in say, I offer you $800,000. The VA come in, I offer you 850, 900. I'm able to pay for that 900,000. I don't have to put in any down payment, right? So those are the things, advantages and disadvantages. Just how the buyers and the realtor helping out them to facilitate a strategy, okay, to help the buyers to buy a home. So like I say, VA is still competitive, just depend on how risky they are and how they use the sell tactics to buy the property. And like I say, VA is guaranteed by the VA, Veteran Affairs, right? VA loans are backed by the U.S. Department of Veteran Affairs. This government guarantee reduces the risk for the lenders and allow them to offer competitive interest rate and term, and also, competition, meaning lower interest rate, better for consumer, right? So when they say, so meaning also that bank will offer it because the VA Veteran Affairs Department guarantee this loan, so they will never lose money. So that's why bank are willing to invest in the VA loans as well. Competitive interest rate, so we talked about that. No private mortgage insurance, no PMI or no MPI. Okay, that's the beauty of the VA. With the VA, you don't pay private mortgage insurance, which is conventional, and you also don't pay mortgage premium insurance, MPI. Okay, VA pay none PMI. Remember that. Okay, when you in the past, right? The only two loan, government loans, no, actually the two type of loan that pay either the insurance is the conventional and the FHA. VA doesn't pay that. Okay. Let me see. PMI is typically required for conventional loan with down payment not below 20%. So we talk about that. Okay. VA is also have a flexible credit requirement. While the VA does not specifically set specific credit score requirement, lenders may have their own minimum credit score standards. VA loans tend to be more forgiving when it comes to credit history. Okay, so they don't care much about the credit score and the past credit history, making them accessible to borrow with varying credit profile. Loan limits: VA loan do not have a maximum loan limit or loan amount, but they do have a conforming loan limit set by the Federal Housing Finance Agency. So I talked about a 1.5 million, right? But if that particular property in that particular county set by the FHFA say the maximum amount is 725, then VA loan can only give 725 for that particular home. Okay. Let me see here. Amount of the VA guarantee. Borrowers can still obtain VA loan for the amount exceeding this limit, but they may need to make a down payment on the portion exceeding the limit. See that? So that's saying, right, if you buy a home that already reached the limit, okay, and that home price is higher than the limit, then that person that used a VA loan need to come in some money, some down payment instead of no down payment. Okay, so let's take an example. I help a client, right? her husband has a VA status, right? And I help her buying a 1.55 million. Okay, so 1,550,000. Okay, and because the loan limit is a 1.5, right? She only down 50,000, and she bought 1.55 million dollar home, right? And so that that you can see that sometimes have a VA is great, right? And also due to the fact that that home is in the in the ocean view kind of thing, right? So the limit is high too. So she able to buy that home with little to no down payment. Okay, so like I said, the on this loan limit thing here, as long as the home purchase price is less than the setting limit by the HFA, then the buyer doesn't need to bring in any additional money, right? Otherwise, have to bring in some difference. Okay, use of various property types. VA loans can be used to finance various type of property, including single-family home, condominium, multi-unit property, up to 4 units only, and manufactured home that meet the VA requirements. And what else? I don't see the mobile home on here. I see the manufactured home, right? Manufactured home are the home that custom built, put it on a slab. Okay, not the one that on a mobile home that's actually moving around. Okay, so VA seems like doesn't accept the mobile home, just only manufactured home. Okay, streamline refinancing. So we're talking about borrow a loan and you refinancing, but with the VA, they have something called streamlined refinancing. What is it? Borrower with existing VA loans may be eligible for VA streamlined refinancing, also known as an interest rate reduction refinance loan, IRRRL, interest rate reduction refinance loan. This program allows for an easier and faster refinancing with reduced documentation requirements. So meaning that if you have a VA loan, you don't have to redo another loan to get a lower interest rate. Okay, you can use a streamlined refinancing, meaning tell the bank, hey, I know the market interest rate is dropped. Can you do a streamlined refinancing for me? Okay, and do it quick. Okay, so meaning that they just change the term of the original loan, match with the rate of new loan, or the new rate, I should say, right? So that way you'll make everything quick and easy. Funding fee. VA loan typically require a one-time, remember this, VA funding fee require a one-time upfront funding fee, which is a percentage of the loan. The fee helps fund the VA loan program and can be financed as part of the loan. Okay, so meaning that fee can be included within the loan, but they will charge that fee. And I believe the fee is kind of high too. I think maybe 2% or 3%. Okay, but we will see in the next several classes if we get the material that discuss about that. So meaning that they don't have the PMI, but they do have an upfront funding fee, which is 2% or 3%. Okay, take that into account. But that amount eventually can roll into the loan too. Okay, home inspection. VA loan require home inspection, meaning that you cannot say that I waive the home inspection. I remove the loan the inspection contingency. Okay, if you remove the inspection contingency, I think you can do it, but you have to anyway do the home inspection. But because you remove the inspection contingency, then you cannot tell the seller to fix anything. Okay, so with the VA loan, sometimes the seller doesn't want to sell to the VA because the process is longer, and sometimes that the home doesn't meet the standard of the VA. Okay, and then VA deny the loan. When the VA deny the loan, meaning that the transaction cannot proceed. Okay, so the home need to be livable. Okay, before the VA can be VA loan can be accepted. Okay, VA loan mortgage program. Some fact about VA loan. VA help, like I say, service member, veteran, and spouses. VA provide home loan guarantee benefit and other housing related program to help you buy, repair, retain, or adapt a home for your own personal occupancy. VA guarantees a portion of the loan, enabling, they say a portion of the loan, because if the purchase price is higher than the loan limit, they only take it up to the loan limit. So that's why I say portion, right? But if the price is less than the loan limit, then it's a whole, enabling the lender to provide you with more favorable terms. Okay, VA home loan. The thing is that lenders, banks, and all that, they scared of losing money. But when there's a veteran affair department guarantee that if this person doesn't pay, we will pay you, then bank doesn't scare anymore, right? They just go out and they fund these VA loan requests. So the VA home loan benefit: no down payment, low interest rate, limited closing costs, no need for private PMI. Okay, VA home loan is lifetime benefit. You can use a guarantee multiple times. I talked about this, right? You get a $1.5 million, you use it up, you sell it, you can reuse that and you buy more, right? So here say that you can use it multiple times. Okay, the requirement for the VA loan, including you need to have a COE. What is it for? It is a certificate of eligibility, meaning you have to have a certificate from your captain or from your, from somebody from a VA department. Okay, say, hey, here is a certificate of eligibility, COE, or a VA form 261880. What is VA form 261880? Which is a form called request for certificate of eligibility. So meaning either you get a certificate already, the COE already, or you fill out a form, a VA form 261880, say, hey, I have the request here, right? And then you can use that to obtain a loan, but eventually you need to receive the COE. Okay, VA service connected disability award letter is not noted on COE. So maybe there's some members, military service member, they may get some disability status. So it's required that you have to have a VA service connected disability award letter, right? If not noted on the COE. Okay. So I think what it means is that you need to have the COE, but if you have like a special disability status, you may need additional letter for that. Okay, which is called VA Service Connected Disability Award Letter. Condo form, if applying for a condo, meaning that if this borrower buying a condo, then they do need a condo form, right? Provided by the VA department. Okay. Some of those are the VA required documents. Here are some of the lender required documents. Okay. So similarly, they do need a COE. Similarly, they need the request for certificate of eligibility, which is a VA form 261880. Okay. For the uniform residential loan application, okay, this is the first time that we see this word. Okay. When you buy a house, you get an offer accepted. The first thing that you're gonna do is you're gonna fill out a loan application. Okay, that loan application is called Uniform Residential Loan Application, which is URLA. Okay, that form is called 1003. 1003 for Fannie Mae and 65 for Freddie Mac. Okay, different entity have a different name for it, but it's the same thing. It's a URLA, Uniform Residential Loan Application. For Freddie Mac, it's called form number 65. For Fannie Mae, it's called form 1003. Okay, for all home loans. Okay, not only conventional but non-traditional loan too, including government loan. Okay, lender requires are you have to have the COE, the 1003, the credit report, the proof of income for 2 years employment, which is including pay stuff, LES for military employment. Okay, LES, I don't see the LES stand. I forgot what LES stand for, but it's a form from the military that say how much they got paid. Okay, W-2 form, bank statement, proof of income, proof of other income. I'm sorry, including if you have investment property, you have rental property, you have child or alimony support and things like that. Right, those are the additional income. Documentation of outstanding debts. If you have any debts at all, you're a VA doesn't mean that you don't have debt. You may borrow a credit card, you may borrow a loan car and stuff like that. So you need to provide all that, including student loan, car loan, child support, child alimony, and other debts. Your lender may use this information to determine if your other debt may affect your ability to make monthly mortgage payment or not. Ability to repay, right? ATR. Gift letter, you can use a gift letter too from your family, immediate family and stuff. Okay, that's done for VA. Now let's talk about USDA. USDA loans, also known as USDA Rural Development Guarantee Housing Loan, or just short for USDA, or should I say USDA Home Loan. It's a type of mortgage loan program offered by the United States Department of Agriculture, USDA. These loans are designed to assist low to moderate income buyers in a rural and eligible suburban areas in obtaining an affordable housing. Key feature and characteristic of USDA loan include rural and eligible areas. Okay, so we know what that is. No down payment. Similar to the VA, USDA doesn't require any down payment, but obviously you can put in some down payment as well. And also similar to the situation where the home limit from FHFA at the certain county, certain area, right? So you have to put some down payment for that. Competitive interest rate, right? Similar to the VA loan. Income limits. USDA loan have income limit based on the area, medium home income, and family size. Borrowers must meet these income limits to qualify. So it doesn't mean that this loan is available to everyone. If you make $100,000 or more, right, dual income, then obviously you're not going to be able to get this loan. But maybe, let's say maybe $75,000 per family, then maybe you are qualified for this loan. Okay, credit score requirement. While USDA loans are more linear than some other loan programs, borrowers are generally required to have a credit score of 640 or higher. So when we in the test, we hear what are the minimum credit score for USDA? Remember, 640 or higher. Lenders may consider alternative credit history for applicants with lower score, like rent payment. Okay, nowadays that they take into account rent payment too, right? If you have a lower score, just slightly over, maybe 610, 615, they say, okay, show me your rent payment, then maybe we would take that. Okay, loan guarantee. USDA loans are guaranteed by the USDA. VA loan guaranteed by the Veteran of Affairs Department. USDA loan guaranteed by the USDA. Awesome. Okay, which means that if the borrower defaults on the loan, the USDA will reimburse the lender for a portion of the losses. Okay, a portion of the losses, meaning that the bank going to foreclosure the house, and the bank going to sell the house. Okay, and if they sell and they don't recoup all the money, the USDA or the VA, depending on the loan, will pay them the remaining. Loan types. USDA loan can be used to finance a single-family home, condominiums, and certain types of manufactured housing. I don't see mobile home in here. Manufactured home, condominium, single-family home, 1 to 4 unit. Why we only hear 1 to 4 unit most of the time? Because 5 or more are considered commercial. Okay, keep that in mind. Maybe in one of the questions they say, okay, what type of home is qualified for VA or USDA? And they say one dwelling, 1 to 3, 1 to 4, A, B, and C, and then D is 1 to 5. No, 5 and more, right? You got to be careful. A is say 1, B is say 1 to 3, and C is say 1 to 3, 4, and D is say A, B, C. Then D is the correct answer because it actually covers all those listed above, right? E may say 5 and more, then that's incorrect. So you got to be careful when you read the question and you read the answer. You don't see the right answer you pick, and you're gonna completely get the wrong answer for that particular question. Okay. Long time. Continue. They are typically offer a 30-year fixed rate mortgages, providing stable monthly payment, same monthly payment for all 260 months. Funding fee. USDA loan require a one-time upfront guarantee fee, similar to the VA loan. VA loan require a one-time upfront funding fee, and so does USDA, which is rolled into a loan, right? Loan amount does not need to be paid out of pocket at closing. Okay, so meaning that funding fee, upfront guarantee fee will roll into the loan, so that the borrower, no down payment, doesn't need to put any additional payment for this fee. So literally you buy a home with no payment and no money. Okay, all right. Okay, so like they say, this fee helps support the program and its benefit to provide to the SDA, borrowers. Home inspection. USDA loan typically require a home inspection to ensure that the property meets the certain safety and livability standards. So similar to VA, USDA also require home inspection. So you got to see that VA and USDA are the same. Okay, except VA serve for the military, USDA serve for other low income folks. Okay, with a certain limit income. Okay, fact about USDA loan, also known as USDA, also known as Section 502 Direct Loan Program. Okay, this program help low and very low income applicants by buy decent, safe, sanity housing. Sanity, right? Take a look. Remember that word sanity, because like VA and USDA, they don't want you buy a home that you have to go in there. You have to first, you have probably put in some money to renovate it, or second, is you may get sick in it. We don't want you. We help you. We give you the money. We don't want you to get sick. Live in a home that is not livable, right? So there's some guidelines, some restriction to that. Okay, by providing payment assistance to increase the applicant repayment ability, must have an adjusted income that is less at or below the applicable low income. They must also demonstrate a willingness and ability to repay, right? They have to have the will. You don't buy a home and you don't pay. You have to have a will to pay and have the ability to repay the debt too. Properties must be located in an eligible rural area. There may be a map, something, or you pick a home, you send that address to the USDA. USDA say, okay, this qualified. Oh no, this not qualified. Property must be located in the eligible rural area. Maximum loan amount an applicant qualify for depend on their ability to repay a loan. So they must be qualified to borrow the money to pay. Okay. So I need to speed up a little bit here. Okay. A couple of characteristics for the FHA, VA, and USDA. This is a combined. Okay. This is not just one particular program. Type of government guarantors include VA, USDA, and FHA. Okay, those are the government sponsors or guarantors. FHA loan limit. FHA loans have a limit on how much you can borrow, floor, or ceiling. Okay, 3.5% down minimum. Okay, and that means that you cannot just go out and you buy a $2 million home using FHA. Right? It's also low limit to a certain county. Okay, here is an interesting fact about FHA that I haven't mentioned. The limit is set at 115% of the median home price for the county. So meaning that the loan limit Okay, let's say they combine everything. Let's say in San Diego. Okay, the county say the median home price is 800,000. Okay, and this family go now and buy a home that 15% higher than the 800,000. Okay, then they can qualify for that loan with the 3.5% down, right? The loan could be, let me calculate it. I don't know exactly. So let's say if it's a $800,000 home, and the loan limit is up to 1.15. So you can buy a home at 920,000 with a 3.5% down. Okay, or it's gonna be a loan is 920 in addition to a 3.5% down. So the purchase price could higher. Let's say 930, for example. Okay. Okay, definition of a VA. We already talked about that for a veteran. Definition of I'm sorry. The VA entitlement. I talk about the 1.5 million. That 1.5 million is a VA entitlement. And I think that number may change depending on the number of service or whatever they calculate in the VA system. So VA entitlement is that amount, that big chunk amount. For this example, it's a 1.5 million. Okay, so that's the entitlement. If you're using a million of it, you have $500,000 left. You sell your home for 1 million, now you get back 1.5 million. Okay, so that is called VA entitlement. It's the amount a veteran may have available for guarantee on the loan. Okay, you use part of it, you have the remaining. Okay, certificate of eligibility, COE, is a proof of VA status to show your lender that you are qualified based on your service history and duty status. So you need the COE, certificate of eligibility letter. Acceptable fund for down payment, closing costs, including bank account, retirement account, sale of your personal property. Okay, you can sell your watch, your car, whatever. That money can be used to buy a home if you want to put a down payment. Property eligible for FHA purchase transaction must be, for FHA, must be your principal resident, must be owner occupied, detached or semi-detached houses, townhouse, row house, condominium, FHA approved condo projects. Okay, for VA, again, the funding fee, we talk about that. Funding fee is a one-time payment for a VA service member. The fee help to lower the cost of the loan. For U.S. taxpayers in the VA home loan program doesn't require down payment. Okay, so just a one-time funding fee upfront. Okay, upfront mortgage insurance premium for FHA. FHA require a MIPS. Okay, mortgage insurance premium. An upfront MIP, an annual MIP, which is paid monthly. In 2022, the upfront MIP is equal to 1.7%. So I talked about earlier, what's the premium for the insurance, right? So for the FHA, it's a 1.7% of the total amount. Okay, 1.7%. So you have to pay that upfront MIP for that, and that actually roll into the loan. Okay, these payments are deposited into an escrow account that the U.S. Treasury Department manages. Oh, we talk about conventional loan. We're talking about servicer. Now we're talking about VA loan. And VA loan open an escrow account, and the U.S. Treasury Department manage that account. Okay, they are a servicer. Okay, residual income qualification test. Residual income is calculated by adding up your monthly income, deducting the payment, excluding your mortgage payment to be limited by the reverse mortgage, monthly property charges, and estimate utility and maintenance costs. Okay, so this is let me see here. What does it say here? This is, I see that it's using reverse mortgage here, excluding mortgage payment to be eliminated by the reverse. Okay, so this is just a way of calculating the residual income for a borrower. Okay, you have an income, you have a property tax, you have a home insurance, you have auto payment, you have credit card payment, You have maintenance and utility. You add all that up, and you subtract by the income. Okay, so in this example, the residual income is $1,563. Okay. Okay, required document. Okay, we talk about this. FHA, VA, USDA, they may have the same requirement, right? 2 years tax return, W-2, 1099 for the last 2 years, pay stub 2 months, self-employed income tax return year to date. If you have a self-employed, right, you got to provide your income from year to date. Okay, profit and loss, meaning that if you have a business, you can claim that you make this much profit, you lost this much, right? But in order for you to qualify the loan, you need to make money. You don't say that your loss is more than your profit, okay? And that required for past 3 years for self-employed borrowers. Monthly mortgage insurance payment scenario, FHA loan will include both an upfront premium fee, which can be rolled into the mortgage, and a monthly charge, which is added to your mortgage payment. Okay, the upfront fee is 1.75. So we talk about this. Okay, FHA require appraisal. Okay, FHA, so far we're talking about premium insurance and all that, right? Down payment, non-down payment. But FHA, in order for you to get the FHA loan, they need to send out an appraiser, and that appraiser gonna appraise the house and see how much this is. Okay, so and the appraiser is appointed by the FHA department. Okay, not by any automated system or whoever appraiser out there. Okay, FHA approved appraiser gonna come out and they're gonna inspect, and the home must meet some certain minimum standard. The roof need to be okay, there's no leak on it. The wall need to be stable, there's no crack on it. So there's a higher standard. When the FHA approved appraiser come out. Okay, they're a little bit stricter than the regular inspector. Okay, if the home doesn't meet these standards and the seller won't agree to the required repairs, and you must pay for the repair at closing. In this case, the funds are held in escrow until the repair are made. Okay, so meaning that you have to repair it before you can close it. Okay, we talked about reverse mortgage. Guess what? Must be 62 years or older. Okay, to convert portion of your equity into cash to take back the money so that you can live comfortably. Okay, hopefully it's not overrun that much. Okay, here's the, let me see. Okay, that's the last slide. Okay, FHA loans versus conventional loan. Here's comparison. Okay, you have a column, a middle column for the FHA loan. You have the right column for conventional loans. Let's see what's the difference between the two. Okay, for the FHA loan, the minimum credit score, right? We haven't talked about the credit score yet for the VA and FHA, right? We talk about the USDA. What is the USDA minimum credit score? Anybody remember? 640. Okay, 640. But in this case, right, we compare FHA, the minimum credit score for FHA is 500. Conventional, usually they go with 620 or higher. Okay, down payment, right? Let's say we have the credit score 500, conventional, score 620. Now the down payment for FHA, you can go with 3.5% with a credit score of 580 plus, and 10% is lower than that. Okay, so the higher the credit score, the lower that you can go with down payment, right? So if you have 580 plus, you can down 3.5%. If you're lower than that, you have to down 10%. It's a requirement. Conventional loan, you can down. Oh, guess what? We thought that FHA loan has a low down payment of 3.5. VA, USDA, you don't have down payment. FHA, you have 3.5. But guess what? Conventional, you can down 3%. It's even lower than the FHA, right? But of course, they need to meet some criteria from Fannie Mae and Freddie Mac to be conventional loan. Okay, you can go 3%. You pay the PMI, that's fine. If you qualify to pay for the PMI, right? But anyway, conventional loan, you can down between 3% and 20%. Loan term for the FHA, 15, or 30 years. Conventional, you can go 10, 15, 20, or 30 years. Mortgage insurance, FHA, you get a one-time upfront fee with 1.75%. Remember that? We talked about that, right? Upfront fee. Upfront fee for FHA is one time and is 1.75. Okay, and the mortgage insurance, we did this calculation earlier, right? Mainly 11 years. Okay, or the lifetime of the loan depending on your LTV. If LTV is higher than 90%, you pay the whole term. If it's lower than that, you pay 11 years, PMI, or should I say MIP. Okay, none with the down payment. There's no PMI if you're down 20% or more. If you're down less than that, there's some PMI for it. Mortgage insurance premium upfront 1.75 plus loan plus annual of 0.45% to 1.05%. PMI 0.5 to 1%. So that's how they calculate, the PMI. When they say 0.5 or 0.45, right? They take the percentage of the loan. Okay. Okay. Down payment gift for FHA, you can use 100% from anybody because it's only 3.5% or even 10%, even 20%. Okay, but the goal of FHA is that you down low, you pay a one-time fee, right? So usually you don't want to down too much. Okay, and you can also use the gift from anybody in your family. Only for the conventional loan, only part can be gift if the down payment is less than 20%. Okay, down payment assistance, yes, FHA may have some down payment assistance. Conventional loan, no, you're on your own. Thank you. A lot of information, and I overran 9 minutes. Sorry about that. Yeah, I know. I already told you, at the beginning, it's gonna be overrun because I have a couple more slides compared to yesterday. Okay, anybody have any question? Interesting stuff, right? We're talking about government loans. We're talking about FHA. We're talking about VA. We're talking about USDA, and some differences, some characteristics, right? Credit score, requirement, and all that. Good stuff. Okay, anybody have any question for me before we enjoy the weekend? Nobody? Come on. Ask me a question. I'm here for you. Okay, if you don't have any question, I'll see you next Monday. Ciao.
Thank you.
Bye em.
Bye.
Bye em.